Hello, I'm Parmentier. I'm going to talk about cash flow, how you have to calculate the cash flow of your company. Okay, here you have the formula for calculating the cash flow. So you should know very well what cash flow you want to calculate. This is what we call the equity cash flow. That means it's the cash flow which is available for the shareholders after the company has paid everything she should pay. So we call it equity cash flow. And the formula is that you take the earnings after taxes, you do add your depreciations and amortizations, and you deduct or add the working capital requirements and the investments, and you deduct and add the financial debt. Now this is just theory. I will show you in practice how you have to do it. Okay, cash flows, they start from the P&L. Now it's important that you know where you have to start with. You don't start with the earnings after taxes, which are totally below of your P&L. You actually start with your ordinary profit. So as you can see, you have turnover, you have the costs to realize this turnover. The difference is what we call an EBIT. And then we have the financial income and the financial return of the company, which brings you at the situation of what we call ordinary profit. The logic is that from this ordinary profit, you do actually deduct your taxes that you expect to be paid on this ordinary profits. You have to look to your local GAAP, because it could be that in your local GAAP there are exceptional items which are included in the EBIT. It's very important you take them out. Why is that important you take them out? Because you want to calculate what the normal cash flow is from this company in normal activities, during its normal activities. So exceptional items you always have to get out of this cash flow calculation. Another thing is, this is not a cash stream. You're not going to make the link between the begin situation of liquidity and end situation of liquidity. That's something totally different. It's also called cash flow. But the cash flow, the equity cash flow we are calculating, is really the cash flow the shareholders could have in their pocket if the company is realizing these cash flows. So it's very important you're not using the earnings after taxes. Also very important, don't use the historical taxes you paid. You have to calculate the normal tax rate and calculate the normal taxes you have to pay on the ordinary profit. Okay, let's continue. Okay, you start with your ordinary profit. This is period N-1, period N, the budget. And you do calculate the normal tax rates. Now, suppose this is 25%, this will be your taxes. So you see, these taxes are different from the historical taxes you paid, because you want to know what's the normal cash flow I can realize in my company. Because the depreciations, you did not pay them, but you just booked them, you add them with your earnings after taxes you have here, and you have what we call an ordinary cash flow. So you see in the budgeted year 2 million, 2 million to 1.6 million. Then it's very important you have a look to what you have to pay back to the banks, because the loans you have to pay back, you have to be able to pay them out of these cash flows. And these cash flows won't be the cash flows which will be available for the shareholders, no, because the first thing you have to do is to pay back your bank. So you see here the loans we are paying back to the banks, and we see there's 1 million, 1.4, 1.4 left after we have been paying the bank. Now there's something else we still have to finance from our cash flow. And what do we have to finance from our cash flow? That's also what we call, in fact, the working capital requirement. And if a working capital requirement is increasing, it will decrease your cash. So if you calculate your working capital requirement mutation, you see the working capital is going up, the working capital requirement is going up, you have to deduct it from your cash flow. Now, to know what happens to your working capital requirement, you make your managerial balance sheet. If you don't know how to make it, have a look to my YouTube films, how to read a balance sheet. In that videos, I explain you how you have to make this managerial balance sheet. In this management balance sheet, you will calculate your working capital requirements, and you see here 23.6 million, 23.09 million. That means there's a decrease of working capital requirement. That means cash is being added. And here you go to 3.4 million. That means cash is disappearing due to the fact that your working capital requirement is increasing. So now let's have a look to this decrease here and to this increase in our cash flow statement. So after we paid back the banks, we have 1.4 million left. The working capital requirement did decrease, and if it decreases, it increases, it creates cash for 545,000, which brings my cash flow on 1.9 million. In the budget, there was an increase of the working capital requirement of 400,000, and my cash will be 1,036,000 euros. Question is this what is left for the shareholders? No. If you have this amount, you still have to deduct the recurrent investments the company has to do to keep in business. So if we would say at 600,000 the recurrent investments we have to do, there is left 1.4 million in period end and 436,000 in the budgeted year. This 1.3 million and this 400,000 is what we call the equity cash flow, and is in fact the cash flow the shareholders can expect to have as an increase at the end of the budgeted year here of 436,000 and of the realized year of 1.4 million euros. Watch my next video because we can still have a lot of things we have to tell about the cash flow statement.